Hi, everyone. Welcome to Peterson Wealth Services Point of View. My name is Shaun Peterson. Wanted to jump back on here. Last time we put a video out, I talked a lot about savings or investment accounts, let's say for younger children, particularly minor accounts. So we talked about UTMA accounts, if you remember. We also talked about 529 saving plan accounts, and then we talked about Roth IRAs. And just to piggyback on that, I thought, okay, we've talked about kids. Let's talk about maybe working adults, people that are in the workforce right now. What type of accounts should you all be considering for your own retirement? And I'm going to start with, I think, what is the most common, which is a 401k. I think most people would say, yeah, I've heard of a 401k plan. 401k is just the IRS term, the code that they use for these plans, and it's an employer-sponsored plan. So most employers out there, I mean, not most, but a lot, offer a 401k savings plan for their employees. Now, you also hear terms like 403B plans or 457 plans, very similar. One is just government-sponsored plan. The other one is like a nonprofit savings plan, but similar contributions, similar ways that they work, but I'm going to stick with 401k. So 401k is where you have the opportunity to defer your salary into an account for you, and then it gets invested in usually a menu of mutual funds. And I'm going to jump back to that because it doesn't always get invested. It's on you to make sure it gets invested. A big part of most 401k plans is that employers offer a match. So you put money in and they match it up to a certain percent. A very common percentage is 3%. I've even heard of some plans matching up to 6, 7, 8, 10%. So depending on where you're working, they're likely to have a match for you. Now, if you're working somewhere, they offer a 401k and they offer a match and you're not participating in it. Number one, you're not saving for yourself. You're not investing for your future. Number two, you're leaving free money on the table. So I would be reaching out to my HR person, to my boss, whoever it is that is in charge of it, and saying, hey, how do I get signed up for this plan? Now, most 401ks have two different types of funds in them. So common one that people know are pre-tax deferrals. So your money does not get taxed. It's automatically deferred into the plan. It gets invested and it grows tax deferred is the term that we use. And then when you retire, and you really want to leave these funds alone till at least 59 and a half, or there's an early withdrawal penalty. Say you retire at 65, you build up this account balance and you start taking distributions. You don't cash out the account. I wouldn't advise that, because once you take money out of this pre-tax 401k, that's when you pay income tax on those distributions. So usually you're just taking enough out to maintain your lifestyle. You don't cash out the whole account. I mean, we see 401k accounts with millions and millions of dollars in them, and it would be kind of foolish to cash all that out and pay all the tax in one year. The other type of funds that are in these accounts are after tax or Roth 401k dollars. So you get paid, you pay your tax, and then you defer into the Roth 401k. So you're done with your taxes on that, and they grow tax-free in the investments and come out tax-free once you hit 59 and a half or older. I think I would lean towards that if you're a younger person. Sometimes there's debate on if you're a higher income earner, should you be doing the pre-tax to get the income tax deduction today? So it kind of depends on your situation, but maybe consult with us and we can help you narrow down the pros and cons of each deferral type. And if your plan even offers Roth, I would say 90% of them do. If not, it's something that you could add to that plan. So the max limits for 401ks right now are $23,500. If you're 50 or older, you can defer an additional $7,500 into the plan. If you're 64 or older, you can do a super catch-up. So the $7,500 is a catch-up contribution. The super catch-up is for 64 and older, and it's an additional $11,250. So if you put off putting away for yourself, you're trying to catch up, there's those options there for you. So you can put a nice chunk of change away. Now, some employers will actually offer a profit sharing on top of the match that they're always already doing. And those are typically discretionary. So it depends on if the company's done well or not, but you could potentially see more money put into these accounts. It used to be when you would go to work for a company. You'd work there all your life, right? That was the common thing. It's not so common now. People jump around all the time, but you'd go to work for them. And then when you retired, they had a pension waiting for you. And a pension is just a guaranteed monthly income to you. So it's kind of like Social Security. You're getting just your monthly check. There's not necessarily a lump sum there available. Now, some plans do offer a lump sum on their pension, but some don't. The problem is pensions just aren't offered as much anymore. So it's becoming not really the employer's responsibility for your retirement. It's the employee's responsibility. It's you putting away, it's you deferring, it's you making wise investment options with those 401k dollars. So just food for thought there, very important. And the earlier you get started with these plans, in my opinion, the better. And again, just because the money goes into the 401k, that has nothing to do with how it grows. I hear people sometimes say 401ks don't grow. And I say, well, what's your 401k invested in? I don't know. It just doesn't grow. Well, maybe it's in a money market. Maybe it's in a fund that's too conservative. Maybe it's in a bunch of bond funds and you don't have any growth funds in there. So it's important to analyze, look at those funds, work with us, your advisors, to make sure you have a good allocation based on your goals and your risk tolerance. Okay, moving on down the line here. Talked a little bit, let's say you work, and I talked about this in my last video, but let's say you work somewhere and they don't offer a 401k. Well, start looking at IRAs and Roth IRAs, so individual retirement accounts or Roth individual retirement accounts. You can set these up at pretty much any investment custodian, and you can start deferring your own dollars in there. Now, you're likely not going to get a match from your employer on this, so it's just you putting your own money in. The limits are $7,000 for an IRA, $7,000 for a Roth IRA. And if you're 50 or older, there's an extra $1,000 catch-up contribution. So you can max out at $8,000 if you're 50 or older. And again, just because it goes into that account doesn't mean it's invested yet. You have to select your investments inside of those accounts. And then the same thing, a traditional IRA is your pre-tax. So it grows tax deferred, then you retire, and you pay income tax on your distributions. With the Roth, it's after-tax dollars. You don't get the tax deduction today. Grows tax-free, comes out tax-free as long as it's a qualified distribution, which basically means the contributions have been in there for 5 years or longer. So again, great accounts there, something to definitely consider. With you self-employed individuals, and I'm talking self-employed, no other employees, a great option for you is called a SEP IRA. Now, a SEP IRA is all pre-tax, and you put money in and you're getting that tax deduction. You can defer the lesser of 25% of your adjusted gross income or $70,000, whatever is less. That's the 2025 limits. Again, money goes in the account, gets invested. You're building up a nest egg for your retirement. So now maybe you're a business owner and you have multiple employees and you don't really like the SEP option. The SEP option is tough for employers with multiple employees because whatever percentage you do for yourself, you've got to do it for all your employees. So you may want to consider setting up a 401k plan. And if you are considering that, reach out to us so we can talk pros and cons and the differences between these different employer-sponsored plans. Another option for business owners is called a simple IRA. So similar to a 401k, but there's less reporting that has to be done. They're a lot easier to set up, not a planned document, all that stuff. You can defer, I believe it's around 16,500 into those plans, and they do have a matching component for your employees. So the point of this video is kind of talk a little bit, not just about kids, but working adults, people in the workforce, even if you're nearing retirement, like what are you doing with your 401k? Do you have something? Do you need to be setting up IRAs? Those accounts we talked about, pre-tax, tax deferred, and then you pay tax, or the Roth is after tax, grows tax-free, comes out tax-free. Another simple account is just an individual or joint brokerage account. Now, account like this, you can set up anywhere, again, at a custodian, and the money's going to get invested for you, but it is taxed as you go. So you get a 1099 that would report any realized gains. So that means something was bought and sold for a gain, or realized losses. Something was bought and sold for a loss. That's reported on your 1099. Pay capital gain tax on those gains as long as it's held for a year or more, the investment. And it will also on the 1099 report any interest and dividends received. Now, some people say, well, I don't want to pay tax, so I'm not doing that. And my response to that is, you're paying tax on only if your account gained. So you could just park it in the bank and not make any money and never pay tax. But I would rather be having my money grow and paying a little bit of tax along the way. So if you do this right and structure things, you could have money in the tax deferred account, a tax-free account, and a taxable account. So three different pools of money for you to choose from when you retire to help replace your lost income in those retirement years. So throwing a lot of information at you. We're here to answer any questions that you might have. We're able to handle all types of these accounts. Even if you have a 401k that's held outside of here, we could take a look at what options you have inside that 401k and help you understand those, and you can make some decisions on it. Anyways, hope you enjoyed this information. If you have any questions, please reach out to us here at the office. We're always happy to help. Thank you.